China has taken the last few months to increase scrutiny on some of its biggest businesses. It seemed to start with Ant Group in the pulled IPO. It spread to DD Global, which is now well below its U.S. IPO price. And just today and yesterday, Tencent's WeChat temporarily suspended registration of new accounts. The reason, the company told Reuters, it was to align with relevant laws and regulations in China. Talk about after-school tutoring. And that got out of control. Let's talk with an influential investor who's been paying close attention to China and the country's government for years, Kyle Bass, Heyman Capital Management founder and chief investment officer. We know China wants to compete on all levels, economic. Now we're hearing about another nuclear silo plant, a new missile base for China. Kyle, I don't know if you saw the New York Times report. That's the second one in recent weeks. Capable of having a lot of missiles put there, whether they put them there or not. It seems to be leaving the minimum deterrent strategy it had and joining the arms race with the U.S. and Russia. Is this all? Does this make sense to you? Part of your overall thinking towards what China's trying to do?
You know, one of your prior guests said that even Stevie Wonder could see what was going on. And I'm going to tell you, it's easy to see once you understand the fundamental ideology of the Communist Party of China. All of the things that are happening today are impossible to discount. They're easy to see coming at some point in time. And I think that's where, when we think about investing, first of all, Chinese companies won't submit themselves to covered audits like all U.S. companies do. Now you have to discount Xi Jinping risk or Communist Party risk. How can you pay a huge multiple of earnings with all of those things in front of you? You know, this is going to be a panacea for plaintiffs' lawyers and for individual investors when they start bringing arbitrations against their fund managers, their brokers, their RIAs. I mean, there is no defense for a fiduciary that invests in China today.
What is the end game? Because we've talked about it that, you know, obviously at state-controlled businesses, if the state feels like it's losing control, they're gonna come in and assert themselves. Maybe that's it. But we've talked about that this could dampen GDP growth down the road. That part of the last 20 or 30 years, the miracle in China has been innovation in what is kind of a pseudo-private sector. So why clamp down on that and kill the geese that are laying the golden eggs for China? Why is this more important to Xi Jinping?
So I actually think it's bigger than just China, believe it or not. I think that given the financial crisis, the global financial crisis in 2008, and now the virus crisis of the last couple of years, you've seen central banks around the world expand their balance sheets aggressively. And we all know in the U.S. alone, there's 35% more broad money in the system today than there was a year and a half ago. So what's happening is, right, we talk about inflation, but the differences between asset values moving up and the poor becoming more poor because they're having to pay more for food and energy and the basic staples of life. The middle class can't reach up because asset prices are moving too quickly. This is fundamentally core to what China is struggling with today. They have 400 million people supposedly in the middle class, which we define it a little differently here. Then they still have 1 billion people in abject poverty. And that when that gap widens too much, China has to clamp down and figure out how to stop social unrest, because that's their worst fear as a country. And so I think all of this is actually rooted in the amount of central bank expansion globally. And now what you see China doing is the government has total control. It's impossible to discount. They went after the food companies yesterday. They went after for-profit education the day before. It all started with Ant Financial, and now it's moving into Tencent and Attack. And what's next? Healthcare. I talked to a bunch of my friends today that are big global asset managers, and they are finally starting to really materially pull out of China and Hong Kong. This is just the beginning.
Well, whether it's to maintain control over the masses or to try to bring more people into the middle class, you could almost say that regardless of their intentions, that could be a good thing over time. But what does it mean for the United States and for tension and for what looks kind of like a new Cold War at times in the way we're dealing with, and that maybe it's an economic Cold War or a financial industry Cold War, but it's definitely increasing tensions with the rest of the world.
I mean, look, it's now easy to see the Chinese Communist Party has shown you who they are and what they care about. And again, as an investor, it's unconscionable to think about how you could invest in one of these Chinese companies without audits, without the ability to discount risk. But as far as what their end game is, you look at what they're doing with their U.S. listings, and at the same time they're expanding their ability to bring companies into Hong Kong, and they're saying that Hong Kong is going to adjust its listing requirements to make them much easier for Chinese companies to list in Hong Kong. I think Beijing's hopes here are that people are going to stop investing in Chinese companies in America and start investing in Chinese companies in Hong Kong. I think it's a grave miscalculation on Beijing's part.
Shepard Smith here. Thanks for watching CNBC on YouTube.